Hi there, eToro. It is Monday the 26th of July, and that means it is time for my weekly review. Let's take a look at what moved the market last week. Right, a few more lines on the chart this week. So the candles are the S&P 500. So for the 12 months back to July last year, the S&P 500 has put in a 37% return. My portfolio's put in a nearly 46% return. The reason I wanted to throw up a few other things on the chart, and which I might be doing in future, is obviously there's been a drawdown through this month, and some of the reasons for that can be expressed by various ETFs. So as you can see here, TAN, this is a solar ETF, CQQQQ is an ETF that represents Chinese technology, and the UK 100 is the FTSE 100. So as you can see from here, the solar stocks were doing very well up until the end of last month. They've had the roughest time through this year. And I'll talk about that a little bit later on, why the reasons around that. But I've been recovering since the middle of May, but I've had a rough month. So those have been part of the reason for the drawdown this month. We can also see that it's less obvious here. I don't own any stocks in the UK 100, the FTSE 100, but there's no other ETF that represents UK stocks. So I've just chosen this. You can see that around the middle of the month, roughly when the UK celebrated Freedom Day, the end of all lockdown restrictions, UK stocks tanked massively. That's also part of the reason for the drawdown that we've seen. And then finally, you can see that Chinese tech stocks were recovering well through the end of last month. They dropped off significantly in the first week. And I don't know if you remember, but that was because of the news that the Chinese government was reviewing the process that Chinese companies use to IPO or to list on US indices. I reduced my exposure at this point, and since then we've seen some other negative news that's driven those prices even lower today. So I'm glad that I reduced my exposure, but even with the reduced exposure, it is affecting the portfolio. All right, so the UK is now seeing the fastest economic growth since World War II. This headline isn't new. I think the first time this headline was published was maybe in May. But now we have more data. We have more economic data that's been published, and effectively it's been confirmed that our recovery is strong, very strong. So it's expected, our economy is expected to grow by 7.6% this year. And although our inflation numbers are rising, they're nowhere near the levels in the US. So the UK was massively damaged by the Brexit vote and the uncertainty around that for the years that went on, and then we had the coronavirus pandemic, and so that double whammy really hurt our stocks and our GDP. So a little tidbit for you: the FTSE 100 last week, when it was selling off, so this purple line here, was just about at the same level that it was in the year 1999. So that gives you an idea of the lack of growth that the UK stock market has seen through the past few decades. I suspect that's changing now. So our government has done well to vaccinate the population, but also is striking trading deals that we need with other countries because we're no longer a part of the EU. And those have been seemingly progressing fairly well, except our trade agreement with the actual EU. So for these reasons, I think that the UK is probably going to see a good few years of excellent growth. I think that we'll see some of that. We'll see a burst of that nowish. And I might as well jump to this piece of information. So it seems as though we have confirmation that the case numbers in the UK have topped out. This is good news because our country has slowly been opening more and more up. And on Freedom Day, like I mentioned, just about all restrictions were lifted. So case numbers are dropping, but also the number of deaths and the number of people admitted to healthcare, while they are increasing, the numbers remain fairly low. I know that these percentages are fairly big, but you can see here that the the number of people that are dying per 100,000 people is 0.5. Every death is awful, but this number is now at a level that is significantly below other annual diseases that every country in the world experiences. I suspect we'll see another little blip, another little increase in cases in the coming weeks because of Freedom Day, because in the UK now people can go to clubs and people don't have to wear masks when they're in shops. Restaurants and bars, pubs, they can operate at full capacity. So I suspect we'll see another blip, but I also think that the trend will continue to be down because we have more than 70% of our adult population is completely vaccinated. This is great news for the UK, but also many people are watching the UK to see how things go and will then expect the rest of the world to behave the same in similar circumstances. So the US has a pretty high level of vaccination and they're doing everything they can to drive that even higher. The EU also has a high level of vaccination, and countries such as Germany are now looking to make it mandatory to be vaccinated. So we'll see how that goes and if that lands. But overall, it looks as though many wealthier countries with a high access to supply of vaccines are vaccinating the populations very fast and also donating a lot of vaccines to those countries that can't afford them. So this is hopefully very good for UK stocks and worldwide stocks. All right, China has last week continued its crackdown on Didi and several other companies. And then there was a rumor that it might force those educational technology companies that provide learning outside of schools to become non-profit companies. And over the weekend, we got confirmation that some part of the courses that these companies sell, they won't be allowed to sell them, or they will have to be, that portion of their business will have to be non-profit. This means that the stocks of these companies has taken absolute beating. But now people are worried that this is going to spread to other parts of the economy. And Beijing has now said that there'll be a 6-month campaign where it will be reviewing the internet industry, China's internet industry. And I'm sure they will be applying regulation to several other areas. So they started with companies like Alibaba and similar businesses, but now this review and this new regulation seems to be spreading to other parts of the economy. This is good. It's good for the people, the population within China, but it's so aggressive and so fast, and there isn't much warning, and it is obviously hurting the Chinese stock market. I'm sure it's hurting the local economy, and it's making investors very, very nervous. So we're seeing this effect in Chinese stocks today, and many of them last week plunged massively, and some of them are in the red today, although they seem to have bounced, some of them at least. We also have the US and China are having official talks once again. The last talks that they had didn't work out very well. It was a very acrimonious meeting, and this one hasn't started fantastically either, but let's hope that they end the meeting on a bit more of a friendly note. If these two nations can show that they're willing to get on and disagree, but disagree in a friendly way, then that should be better for the global economy and the stock market. I mentioned early on that TAN, so that's Invesco Solar ETF, let me zoom in a bit, has had a very rough year to date. So actually the 1-year performance of this ETF, which is made up of a collection of solar companies, it's given an 80% return over the past year, the trailing 12 months. However, the year-to-date return is awful, absolutely awful. Invesco Solar is given minus 18.6%. And we aren't heavily invested in solar stocks. I think that I probably have somewhere between 4 and 6% of my portfolio are in solar, but the beating that they've received over recent months has definitely hurt my portfolio. What you can see is, skipping over China, what you can see is that it's not just solar stocks that have taken a lot of pain this year. Wind energy stocks, whilst not as hurt as solar stocks, have also been hurt in a bad way. It does look as though these companies have found a bottom. Most of them within these ETFs and outside these ETFs have found a bottom. And it is a little confusing, the punishment that these sectors continue to receive. So we all know by now that across the globe, trillions of dollars are going into green energy initiatives over the next few years. However, I suspect a combination of the incredible performance that these companies saw over the past year, together with supply chain issues that affect their profitability, are keeping investors a little at bay. So we probably all know by now that the reopening of the economy, and I know that it's not fully open, but the partial reopening of the economy meant that there was a large demand shock, and that affected supply chains around the world. Suddenly we saw massive demand for particular materials, and the supply chains just haven't been able to keep up. What that means is that companies such as solar and wind companies that require a large amount of raw materials and very expensive bits and pieces of machinery or tooling from around the world, their profitability takes a fairly big knock when this kind of thing happens. So the things that they want need to be shipped from around the world, and if shipping costs increase, then their profitability decreases. And the raw materials that they use to produce their equipment have also seen pretty large gains in their prices because of the same same demand shocks. So at the moment, whilst the supply chains are settling in to a more normal supply-demand curve, it means that these companies are less profitable. And that means that either they take that on the chin and they make less profit, or they push their projects out to a time when they think the supply chains will be repaired. And in reality, I think a lot of these companies are doing a combination of both. This is changing a little bit. So you might have seen the news around First Solar. They're building their own solar plant in the US. And obviously the US is pouring money into local investment for solar companies, but also wind energy companies too. I think wind energy is the number one way for the US to receive its green energy at the moment. So these results are awful. They have hurt my portfolio through this year, but I think the supply chains are settling now, and these companies, they seem to have found their footing and should grow through the next few years. Okay, as we come out of the part of the recovery where everyone was really concerned about inflation, and so that would have been when we were hitting the tops of these spikes. By the way, I have spoken about this before, but I probably spoke to the GDP numbers instead of retail sales or PMI numbers. But these numbers are just as good to illustrate that. So when demand is high, the people supplying whatever that might be, the retail goods or services, they can ask higher prices, and that by definition is inflation. And so when we were seeing these big spikes, we saw the wider market really concerned about inflation. Now we're seeing more reasonable levels. By the way, the blue lines are historic numbers and the gray line is the forecast. The concern has flipped, and it's now, have we done enough to ensure ongoing sustainable growth within the global economy? So that's the fear that we have been seeing recently. And note that these lines aren't flat, right? And the volatility here is enormous. It's the greatest volatility that we have ever seen in the economy. And so this volatility means that investors and just the average Joe is really nervous about the way that the economy is going. But the forecast numbers and what we're seeing right now in terms of sentiment indicates that we will return to very strong in terms of history, ignoring the huge spikes that we've seen recently, strong growth across a number of different geographies. So the European Union is a little bit behind the US because it opened later than the US. So it's still seeing the high spikes, and some records were set last week. But once again, the expectation is that it settles into a more normal pattern of growth. China is more or less ahead of the entire world. So in terms of retail sales, the big spikes are more or less out of the way. And now it's expected that, well, we'll see what effect the recent legislation has had, but it's expected that it'll settle into a more normal pace of growth. And so these are all retail numbers, but similarly in terms of PMI, so this is the business side of things. These are the leading indicators and these are the trailing indicators. Spikes have been seen and were expected, but now it seems as though the expectation is that we settle into a more normal pattern of growth. And so whenever I see these massive knee-jerk reactions like we've seen in recent weeks, I try to remind myself that the most likely path right now, there is one caveat, the most likely path is that the world returns to sustainable and strong growth for probably the next 1 to 2 years, depending on where you are in the world. The one caveat in that, the one thing that I think that could completely destroy that is coronavirus. And that's part of why I've been following these numbers very closely. If for some reason these numbers start taking off, the world is going to have to go back into major lockdowns, and then my entire portfolio will be defensive. But I don't think that is going to happen. These numbers look good, but I will monitor them. All right, so what about for the coming week? I've mentioned the headline thing that everyone's going to be watching, except I think that the eyes are going to move from watching the UK to watching the US and the EU. And there are a large number of companies reporting earnings this week. Roughly 1/3 of the S&P 500 will report earnings this week. And some of the biggest players, you can see them here, from the NASDAQ 100 will also be reporting earnings. So far, I'm trying to remember the exact percentage. I can't remember the exact percentage, but I think more than 80% of companies that have reported earnings so far have beat expectations. Expectations for earnings are very high this quarter. And I think that for the large part, most companies will meet or beat their expectations, and there'll be a few that miss and disappoint. And overall, that will probably continue to carry the market a little bit higher. I do think that somewhere in the next 6 months, we're due maybe a 5 or 10% correction. And depending on how earnings season goes, we might see that sooner or later. But for now, I think that it's all good. It's probably more likely to happen after earnings season. All right, that is it for today. I will talk to you next week. Have a great week and happy trading.